My name is Andrew Stotts, and I want to welcome you to this Valuation Master Class Show. And in this, I talk about things related to valuation. And on Mondays, I've recently been talking about interest rates because interest rates are a critical part of valuation. And before I get started, I want to tell a story. In the 2008 crisis, what ended up happening was that the developed country governments flooded the market with currency, US dollar, euro, and the like. And the end result of that was they drove down interest rates close to zero. And in some cases, interest rates even went negative. And I can remember, as my job as an analyst and a head of research, but also as a teacher, many people say, how are you going to value stocks and use a DCF valuation when interest rates are negative or zero? And I just wanted to highlight that when you're thinking about the interest rate that we put into a DCF model, remember that that interest rate is to infinity. Now, you could say that, okay, we're going to lock in a 30-year government bond, 10-year government bond or something, and that's trading at 1% or maybe at zero. But I would say that ultimately, people don't invest that way. They invest by rolling over time. And so I would look at it and think, what do I think is the long-term interest rate based upon the portfolio turnover, right? And every time that you're taking money out of one stock and into another, there's a portfolio turnover, and that money is available then to be put into government bonds or the like. Now, today I want to talk about some fun things, and I'm going to introduce the global interest rate chart book that I have been producing internally. I haven't published it, and I have gotten some requests from students and others that have sent me emails about this. Now, if you want the email for this, if you want this global book, all you have to do is just send an email to me at Andrew Stotts, and I'll put you on a list that will get you this global rate chart book. And the first thing to look at is long-term government bond rates here. And I made this chart. I just recently updated it, and you can see interest rates bottomed in about 2020 during COVID time. And now we're back to somewhat normal levels at about roughly 4%. It doesn't make sense to do a long-term interest rate chart because, there's a lot of ups and downs. So now what I'd like to do is just review in history this great guy named Irving Fisher, who was born in 1867 and lived until 1947. Now, he's described as the greatest economist the U.S. has ever produced. And Fisher was an intellectual titan whose mathematical rigor and all fundamentally changed economics, yet his personal fortunes became a dramatic footnote in financial history. Now, in 1891, he became the first person to earn a PhD in economics from Yale, and he was pioneering in the application of math. And he built a complex, this is funny, he built a complex water-powered hydraulic machine to model and solve simultaneous economic equations, which predated, of course, the computer age. And finally, he turned mathematical logic into the core language of money, shaping forever how the world calculates interest and inflation. I remember getting his book many years ago, and this particular book on interest rates was published in about 1936. And I remember getting an edition of it and really enjoying going through it and understanding the connections, which are pretty obvious things nowadays that we think about. But he really was able to advance some of this. So let's now continue on. I want to study more about Irving Fisher just because I feel like he's very fascinating and very smart. So let's look more detail before we get into interest rates. But his insight showed investors the actual purchasing power earned, which was the nominal interest rate that, let's say, you get from the bank minus inflation, or what we call the real interest rate. Now, he quantified the time preference concept that interest rates arise from our preference for spending today over savings. So we have to be incentivized to save. And he became wealthy after inventing and patenting the visible card index filing system, which was his system he developed. And he invested in that, and he had a company that used that. And that's also where he lost his fortune. So the Fisher equation is MV equals PT, and that is the money supply and its velocity, the turnover, directly determine the price level for all transactions. In other words, sharply increasing the money supply causes widespread price increases or causes inflation. Again, these are common concepts in economics these days, but he was the one who brought them out. Now, in the spring of 1929, a supremely confident Fisher told the public that stock prices had reached a permanently high plateau. And weeks later, the stock market utterly collapsed, eventually losing 90% of its value, helping to trigger the Great Depression in the US, which was a decade-long catastrophe where at its worst, 1 in 4 Americans could not find work. Fisher lost his entire fortune and his reputation was ruined. What an awful situation to be in. And then, humbled by his losses, Fisher turned to understanding why economies collapse, publishing his debt deflation theory in 1933. Now, he showed that when prices fall, debt becomes heavier, forcing borrowers to sell assets and cut spending, which deepens the slump. It's like a perpetual cycle that just gets worse and worse. So the man who misjudged the crash left behind the tools to understand and manage interest, inflation, and financial crises. So this was his book, The Theory of Interest. And this is the one I got, which I really enjoyed. And it was really summed up his lifetime's research into capital budgeting, credit markets, and what determines interest rates. Now, I think that this is really valuable stuff because interest rates are the key to everything in the economy, whether you're depositing money in a bank, whether you're investing in a bond, or whether you're investing in a stock. You're always going to be interested, what is the rate that I'm earning on this? If we look at the average return in the US stock market over 100 years or so, the stock market has returned 10%. Does that have an inflation component in it? Yes, it does. That inflation component could be, let's just say it's 4%. And that 4% inflation component, when backed out, means that you had a real return in the stock market of 6%. Ultimately, your objective is to get the maximum real rate of return, which is why actually in my book, How to Start Building Your Wealth Investing in the Market, I never talked about real return because I avoided it because I don't think it's necessary. Because what you're trying to do is you're trying to get the highest long-term return that you can, and that comes from stocks. So let's go back into the material here. And so these are some of the things that Fisher left us with. So I'm going to finish up this section by just leaving you with that list of time preference, the real interest rate, the Fisher equation, the Fisher effect, and the quantity theory of money and debt deflation theory. Excellent work. I just thought I would highlight it since we're focused on interest rates. This is the man. Now, just to remind you, I'm going to show you this book in a second. And if you want to get a hold of it, just send me a message at me@andrewstotts and just say interest rates. Hold on one second. So now let's continue. And if you got any questions, just let me know. But before we do that, I want to talk about another finance professional, Jeremy Siegel, who wrote the book Stocks for the Long Run. I love this book. And in it, he basically gives some guideline of where he thinks that, he defines where stocks and interest rates have been, and inflation and bonds returns have been over a very long period of time. It is the definitive guide for sure. I use it all the time. And I made this table out of it just to get a picture. And if we look at the period on the left, 219 years, from 1802 to 2021. Now, that tells us that the long-term government bond yield was 5% and inflation was about 1.4, which would mean real return was about 3.6. And you can also see the post-dot-com period from 2000 to 2021, 7% government bond yield, 2.3% inflation, and 4.6% real return if you invested in long-term government bonds. The future, well, that's my forecast right there, where I think government bonds are going to yield about 6% long-term, and inflation is going to be about 3%, and the real rate of return is going to be about 3%. Therefore, what do you think? What's your expectation for inflation? Now, this is what I want to get into now. We've done a little preview of understanding Irving Fisher, but global easing but higher emerging market yields continues to show high inflation and risk in emerging markets. This is what I'm going to talk about, and I want to say that if you've got any questions as I go through this, then feel free to let me know. Lee says, super interesting history lesson. Yeah, I kind of felt like on this show, I want to highlight some of the titans of finance and things that they did, because I love reading about it and learning about it. If you have a question, make sure you ask, and I'll do my best to answer. So let's just look at this. I have something I call the Global Interest Rate Chart Book. Probably could come up with a better name than that, but that's what I call it. So if you're interested in getting this chart book, just send me a message at me@andrewstotts.com and just say chart book, and I'll send it. So let's go through the first level, which is the interest rate level. And that shows that the 3-month rate around the world is 4.3%, 10-year is at 5%, and it's much higher in emerging markets. But before I go into that, I just want to highlight this. We generally get interest rate by countries. And then what I want to understand is the global interest rates. I'm always looking globally. And so the way that I did that is that I set up a huge file where I took the GDP of all the countries in the world, and then I took the interest rates of all the countries in the world, and I did that on a monthly basis over many years, many periods. And the result of that is that I can market cap weight interest rates. And when you do that, then you could say, here is a global interest rate. Now, it's not meaningful in the sense that you're not going to be able to get the global interest rate. If you're going to get an interest rate, it's going to be based upon what you can get in your country or a particular country. But the point is, this can help us understand what direction things are going. And if we can look at it globally, we could look at it regionally, we could look at it in many different ways. Now, I truthfully have spent, probably 100 hours working on this one Excel file that I use internally. I've never really advertised it, but today I'm going to share with you some of the results of that. So let me go into that and share it. So the first thing is, I like to use this table here, and the reason why there's a lot of blank on this screen because I'm going to build this table out over time that you'll see. But here we can see that the GDP of the world is about $95 trillion of the countries I'm looking at. And the 3-month yield across the world is about 4.3. But in developed markets, we can see about 56.7 trillion in GDP and 2.9, much, much lower than the 6.3% in emerging markets. So average emerging market 3-month government bond yields about 3.3 percentage point more than developed market. There's a premium. There's a premium for inflation, and there's a premium to be compensated for risk. Let's now look from 3-month yield to 1 year. And what we can see is that in the developed world, so globally, 1-year rates are at 4.3, developed market 2.9, which is about the same as we just saw with short-term rates, and emerging markets is about 6.5. So here we can see that these are at about a 3-point emerging market. 1-year government bonds are at about a 3.6 percentage point premium to the developed market. And finally, let's look at 10-year yields, which are 5% globally. Developed markets, it's higher because the yield curve has a normal steepening to it. And so it's 3.5 for 10-year bonds in the West or in the developed market, and 7.2 in emerging markets. So Let's summarize. What did we learn? What are the key points? World GDP in 2024 was about 95 trillion. Developed markets accounted for about 57 trillion and emerging markets for about 39 trillion. Now, world yields for 3 months were 4.3, 1 year were 4.3, and 10-year was 5. So basically, we can see the yield curve is relatively flat. Developed market yields were 2.9, 2.9, and 3.5, and emerging market yields were 6.3 for 3 months, and then 6.5 for 1 year and 7.2 for 10-year. And that gives a pretty significant premium of about 3.3 to 3.6 for the premium of emerging markets over developed. And that's consistent across all maturities. So now that we understand that point in time, what I'd like to do is look at some year-on-year changes. Is it different? Well, here we can see developed markets short-term yields fell sharply and emerging markets stayed high across the curve. So let's look at that here. Here, what we can see is that 3-month developed market yield had a 0.7 percentage point premium fall, to 2.9%. So we can see the bars in the middle have dropped from 3.6 to 2.9, and emerging markets had a smaller relative 0.4 percentage point fall to 6.3. So yes, rates are falling, but by a small amount in emerging markets and a larger amount in the developed markets. Let's look at 1-year yields, and here we can see that there's been a large 0.5 percentage point year-on-year fall to 2.9 in the developed markets, and emerging markets have seen a smaller relative move. Even though it's 0.6 is a larger number than 0.5, the reality is that 0.6 in relation to 7.1 where it was is still a pretty small relative number. And finally, let's look at 10-year yields. And with 10-year yields, we can see that basically they're almost all flat. And in fact, in the West, in the developed markets, it actually went up to 3.5. So let's review what we learned in just a second. But before that, we're going to go through rate progression. So developed market easing while emerging markets stay elevated. Let's look at the trends of what's happening. So here we can see short-term 3-month yields have fallen, and the emerging markets, of course, offer some premium. And what we can also see is that they're all moving pretty much in the same direction. And 1-year yields drop worldwide, but there's steady 2% percentage point premium to the world average. So again, you're getting compensated. When you think about it, just think about the concept that ultimately what's happening is you're getting compensated for the higher level of risk in emerging markets and the higher level of potential inflation in emerging markets. And then the long-term 10-year bond rate, we can see that that long-term rate is, let's see there, emerging markets is about 2 percentage point premium to the world average. And ultimately 10-year bonds, it's hard for the Fed or central banks to move that 10-year yield, and you can see that right here. Let's continue and summarize. Developed market yields fell sharply. 3-month and 1 year were down to 2.9%, and 10-year was steady at 3.5. And emerging market yields eased slightly, but stayed high. 3 months at 6.3, 1 year at 6.5, and 10-year at 7.2. And the emerging market, developed market gap remains wide at roughly 3 to 4 percentage points across the maturities. Now, if you're crazy like I am about things like interest rates, then just send me a message at Andrew Stotts, and I'll send you this chart book because you're going to love it. It's much more than what I'm showing you, but it's really good to scan through as if you were, let's say, on an iPad as an example. Okay, so let's now go into the final section of this, and that's where we look at the yield curve. Now, the way that I look at yield curve here is if you look at the bar chart on the left, you see it's 4.9 and 5.0. I'm talking about the 3-month rate and the 10-month rate, or 10-year rate. And if we take the difference in these two, there's some rounding errors, so don't get too worked up about the exact difference. But from 4.9 to 5.0 is about a 0.2% difference. And as long as the second bar is higher than the first, then we have a normal yield curve. And basically, there's not much going on the yield curve, particularly over the last month. So I'm looking at October versus November. These are November numbers that we're updating. Basically, no change. And if we look a year ago, it's been some steepening, right? Where the short-term rate's gone from 4.9 down to 4.3. Let's look at the yield curve here. And this basically is looking at developed market. The prior one, let's just go back to the prior one, that was world, which was a combination of developed market and emerging markets. Now we're just looking at developed markets. And here we can see that the rate is relatively flat in the developed markets. No change basically from October. And it's a normal yield curve. And the only thing that you can see that's interesting is that a year ago, it was an inverted yield curve where short-term rates were at 3.6 versus 3.4 for long-term rates. That was November of last year. And then we can see emerging markets. And here we can see that there's a small steepening with long-term rates going up a little bit in November and short-term rates going down a little bit in November, which is causing emerging markets to have a 0.9 percentage point gap, which shows you the steepness of the yield curve. And so what have we learned? Well, in November, world flat yield curve was normal, though close to flat, as I mentioned, and developed market yield curve was steeper than last year, though still relatively flat. And November showed a small steepening in emerging markets. So let's wrap this up. And the short-term rates, overall, what I want you to remember is short-term rates fell to about 4% globally, while long-term rates held near 5%. And developed market short-term rates dropped more, now around 3%. And emerging market rates stayed higher, near about 6 or 7%. The premium of emerging markets over developed markets stayed wide at roughly 3 to 4 percentage points across maturities, and yield curves were mostly flat, with emerging markets showing a small rise at longer terms. So the bottom line is global easing, but elevated emerging market yields reflects ongoing inflation. So this gives you a picture of what's going on in the world of interest rates. Interest rates are critical as an input into valuation. So we need to understand where they are in the trends. And I'm going to wrap this up by telling just a little thing to look out for. Whenever we get into a crisis, what ends up happening is people get scared and they feel like everything is very high risk. And the end result of that is that their discount rates go up. And particularly analysts in their forecasts. And then when we're in a boom time and everything's great, interest rates tend to go down because they think plenty of money and interest rates are not a problem. And so the result of that is that they adjust based upon the period of time. What's interesting is if you listen to what Warren Buffett has said about this topic, that he uses a government bond rate and he doesn't adjust that up and down depending on where things are at. So if you, let's say, are swinging up and down with your forecast on interest rates, and imagine that it's a terrible time, economy's bad, everything's bad, so you say, I'm going to increase my discount rate quite a bit. What's going to happen to your calculation of value? You're going to think that things are worth a lot less than maybe they really are. And then there's this pessimism, and there's a tidal wave of this pessimism, which basically causes investors to overcorrect to a particularly negative period. And then imagine the other side, when things are going great and everybody starts to put in low interest rates into their model. And then all of a sudden, people think this is a great time. Stocks are still cheap, therefore I'm going to get in. And then they're getting in right at the top. So when I work with my analysts in Valuation Master Class Bootcamp, what I do is I basically help them think about only adjusting the beta between 1.25 for a high risk company and 0.75 for a low risk company as a way of trying to prevent themselves getting overly excited and happy in their discount rate or overly bearish and pessimistic in their discount rate. And when you understand the long-term movements in interest rates, then you understand why I did that. I want to thank you for joining me and lasting this long. It's a lot of stuff on interest rates, but if you want to get the interest rate book, just send me a message, me at Andrew Stotts. Meanwhile, I hope to see you in the Valuation Masterclass Bootcamp